All right, I think it's good for us to get started here today. Thank you all for those of you who have tuned in. I do see a few people starting to come in, and we appreciate your attendance for this very important webinar to get started in 2021. To give you a little bit of background, my name is Aliredha Walji. I am one of the financial advisors at ShariaPortfolio. Our company is located here in Lake Mary, Orlando, Florida area. We have been in business since 2003, and we are serving clients all over the United States. We have also been expanding our operations through our affiliate companies. We have presence in Canada, and through our funds, SP Funds company. You may have seen some presentations earlier today. We did something from their side on the different ETFs that the SP Funds team has launched. And I encourage you to visit ShariaPortfolio.com for a lot of information that is useful for you and your families. We also have, to get a good scope of the reach of Sharia Portfolio, you can visit sp-wealth.com, and that gives you an idea of our, the different companies that are part of the Sharia Portfolio umbrella. Today's presentation is going to be focused on retirement plans for small businesses. This is a topic that we felt a lot of people have shown an interest in over the years. We generally cover that one-on-one with individuals looking to learn about this topic in terms of what options are available, because it's not a cookie cutter, one size fits all. What might work for one person might not make sense for another business owner. So I think going over the different features, the eligibility requirements, what the tax benefits are, and how to get started will be what we are intending to cover today. A lot of people may also be aware that outside of the company retirement plans that you can set up for a small business, you may be employed with a employer somewhere, and you're offered generally a 401k plan with your employer, or in some cases, they might refer to it as a 403b plan. There are other considerations for that, and we'll have a poll around the end of this presentation to see if there is interest in talking a little bit more about self-directed or brokerage options for those types of retirement plan options. But the core focus of today's presentation, or tonight's presentation, will be on the options that would be beneficial for small business owners. And alongside myself is one of our advisors by the name of Shafaq Qazi. She is going to be available to help answer some of the questions in the chat, Q&A box. I encourage those who have tuned in and those who might be coming in later to submit any questions in the Q&A box, and we'll try and address those as we go along. But the main presenter for tonight is Donna Kramer. She is with a company called BPAS, and we're really excited to have her join us for this important webinar. I'll let her introduce herself, and then we can keep going along into the presentation. So Donna, the floor is yours.
Thank you so much. I'm just going to move this slide here along a little bit, if I can do that. It was working when we started. Here we go. Let's see.
All right. This is just a disclaimer we put on all the webinars, so don't worry about that. If it's just meant to cover. I'll go back. Just go a couple of slides back there. Okay. So yeah, the disclaimer is something you've all seen in prior webinars. Just this is informational only. Advice is only offered on a one-on-one basis. So just more as a general presentation for the benefit of the audience at large. But yeah, this is all we wanted to mention here.
Thank you. Okay, well, thank you for having me. I appreciate the opportunity to partner with you on this webinar, and thank you for everyone joining. So I wanted to spend just a minute telling you a little bit about myself and BPAS. I've basically been in the retirement business for over 30 years. BPAS has been servicing retirement plans since 1973. And basically, we do every type of retirement plan, working with businesses that are sole proprietors all the way up to hospitals, for example, that might have thousands of employees in a retirement plan. On average, we have about 450,000 plus participants among our plans. We service almost 4,000 retirement plans, $86 billion in trust assets, and literally just about $1 trillion in fund administration. Our headquarters are located upstate in Utica, New York, where right now it's snowing every day. That's the report that I get. So, again, that's a little bit about who we are. Next, I want to show you an idea of some of the companies that we provide retirement services for. And when you look at some of these, for example, some of the bigger names on here, like McDonald's, Coca-Cola, we might not be doing their entire plan, but a lot of these huge companies have plans that are broken into different territories. We have a very large trust company in Puerto Rico, and so we do a lot of business in Puerto Rico. So some of these companies we might be doing defined contributions for, defined benefits for, or perhaps just their Puerto Rico plan. But just to give you a feel for the types of companies that we're working with. So, and the last thing about BPAS, just from a structural point of view, is that we are considered, we call it basically one-stop shopping, where 4 roles in one provider, meaning that we do administration, we custody the money in the retirement plan, we do the record keeping function, and we do the trading. BPAS is basically owned by a large bank, also located, headquartered in upstate New York. And that gives us the ability to be a little unique and do our own trading and custody work. So basically, if you bring a retirement plan to us, no matter what the size, we can basically do everything. So you don't need to go somewhere else and find your own person who's going to be a trustee or do the custodial work. We can basically do everything. Again, I don't want to spend too much time here, but just to make sure you have a little bit of an idea of who we are. So now to the issue at hand, which is, why do we want to talk about offering a retirement plan? As we started out saying, this is really focused on small businesses. And we recognize that small businesses, lots of times you're doing everything, right? You could be an owner of a small business that has 10 employees and you're doing the payroll function, you're doing the HR function, you're doing everything, right? So the last thing sometimes that you need is the additional responsibility of offering a retirement plan, because sometimes it might seem overwhelming. That's where basically ShariaPortfolio and BPAS comes in. We could work with you as a team to help you establish a retirement plan that is appropriate for your small business. And as we go through this, we're going to hopefully help you identify what plan maybe makes more sense. What are the differences between some plans? I will start out just with a little bit of a caveat that we could probably spend a half hour or 40 minutes talking about each plan, but A, I would probably put you all to sleep at this time of day, but B, I just don't want to get too complicated with each plan. My goal is to give you a broad overview of each of the plans, and then certainly we can follow up with you with your questions and or any data later on. But just a few stats that I think are interesting. Only 42% of businesses, this was according to a stat last year, only 42% of small businesses with less than 100 employees offer a retirement plan. Why do we, those of us who are in the retirement plan business, worry about this? We worry because the population, is no surprise to anybody, is getting older and older. Longevity is increasing. And since 1980, I came across this stat that I thought was interesting. Since 1980, the population of people who are 90 and older has nearly tripled. So think about that. In less than 30 years, the number of people who are 90 or older has nearly tripled. You know, when I started out in this business 30 years ago, if somebody told me, a client, that they had a parent that was 90 years old, it was like, wow, that was kind of a big deal. And now I'm sure we all run into people all the time who have not only maybe one parent, but two parents who are living into their 90s. So when we think about that, and we know how many people are working at small businesses, the fact that they don't have access to a retirement plan, for those of us, like I say, who our goal is to help people retire successfully, this is kind of a number that we'd love to see shrink. From the perspective of a plan sponsor, why you want to offer a retirement plan is, number one, tax deferral opportunity for you as a business owner, tax deductible business expenses. For example, the contributions and certain plan expenses are tax deductible expenses for you as the business. And thirdly, it's a way in a competitive marketplace for you to recruit and retain quality employees. So that's really the gist of why we feel it's important for you to consider a retirement plan, even if you are a small business. So the types of plans we're going to talk about today, a simple IRA, a SEP, a 401k, and a cash balance plan. I'm going to take each one of these individually, and we'll talk about them a little bit. So a simple IRA, very commonly referred to as a simple, is an alternative. And let me just step back and say that in my mind, the 401k is basically the sort of standard, right? That when people think about a retirement plan. Aliredha mentioned a 403b plan, and a 403b plan is basically just like a 401k, except it's generally only found in not-for-profit organizations, many times hospitals, nursing homes, etc. But in essence, functions almost identically to a 401k. So I would tell you that most people, when they think about a retirement plan, hear 401k, they understand that is what it means, okay? A simple is an alternative to a 401k. Generally, you find this in smaller businesses with 100 or less employees. Both the employee and the employer can contribute to the plan. You'll see as I go through the slides, I try to be consistent so that we understand the differences. So for example, in some of the plans that we're going to talk about, only the employer can contribute, right? So when we're done going through all the plans, we're going to look at how do I kind of identify what plan makes sense for me. And these are the types of things we're going to look at. So for example, in the simple, both the employee and the employer can contribute to the plan, but any contributions that go to the plan are 100% immediately vested. I want to spend just a minute to tell you about vesting, just so that you know what that is as a little bit of a background in case there's anybody that doesn't. So vesting means I own the money, right? So if I'm contributing my own money to any type of retirement plan, it's of course always my own money. It came out of my pocket, my paycheck, generally on a pre-tax basis, and that's my money even if I leave the employer. But employer contributions, which can take many different forms, sometimes can have a vesting schedule applied to them, and sometimes they have to be, according to the government, 100% vested as soon as you give the employee the money. So if that's something, for example, if you have an organization that has high turnover, right, you may not be interested in a plan that is immediately 100% vested, because you might have to give this money to people and they're turning over rather quickly, but as soon as they leave, they're entitled to take that money with them. Versus a plan where you can have a vesting schedule where it says something like you are not entitled to keep the employer money or own the employer money unless you work for us for 3 years. Okay, that's called a 3-year cliff vesting schedule. And so what that means is that if somebody leaves you before 3 years, they're entitled to take their money with them, but you as the plan sponsor, the employer, their money goes back into the plan for you to use to offset future contributions or perhaps pay plan expenses. So that's one of the things that between us at ShariaPortfolio and BPAS, we would talk to you about. What kind of turnover do you have? What is the goal of the plan? Is a vesting schedule important or not? So with that as a little bit of a background as I go through some of this. So again, the contributions here are 100% vested, meaning that as an employer, once you give the employee this money, you must make that money 100% vested. A simple, if you offer it, has to be offered to all employees who make more than $5,000 in the prior 2 years and are expected to make that in the current year. So that means that you don't have a lot of flexibility in terms of keeping people out of the simple plan, if you will. So again, we see a lot of simple plans in smaller organizations where maybe the plan sponsor doesn't think they're ready yet to fully invest in a 401k plan. And we see many, many times people moving from a simple plan into a 401k plan. It's sort of like you're growing up and you're getting into the, the big leagues when you offer the 401k plan.
Right. One thing I've actually also, by the way, Donna, seen is sometimes it's a cost consideration, because if people find that 401ks might have a setup fee or an administrative fee, and if the nonprofit organization or any other organization, their employees are not earning as much, so their potential for contributing is lower, this could also be something that might appeal to them, right?
Absolutely, absolutely. So there's no question that a simple, hence its name, a simple plan is simpler than a 401k, which is why a lot of, as we say, startup companies, companies not that, are still kind of growing and don't maybe have the money that it takes to, as you say, set up a 401k, use a simple plan. There is no non-discrimination testing. There's no annual IRS filing requirements. So it really is much simpler to administrate than a 401k plan. But with that comes some restrictions and some limits. And in other words, when you get to, you'll see when we get to the 401k, we have a ton of flexibility in terms of how creative we can be, right? And all the different bells and whistles that a 401k plan can have, okay? Here in a simple plan, we don't really see that much flexibility. So for example, it jumped ahead on me a little bit. There we are. So for example, the limit here that people can put in and that the employer can put in or match is less than in a 401k. So again, that's a consideration. If I'm a business owner and I'm looking to maximize how much money I can save for my own retirement, the simple might not be the best option, okay? For example, loans are not permitted in a simple plan. Most 401ks and 403bs allow for loan provisions. So those are the types of things that, what I'll call more robust plans might offer. But again, so simple plan, take it for its word, simple, less administration than a 401k, less costly than a 401k. But two of the, big things in my mind is that there's, some caps on the limits compared to other plans, and all the contributions that the employer makes are 100% vested from the beginning. Okay.
By the way, we also have these slides and the information, a handout that we'll share. So those who are tuning in, just, who have registered or are currently attending, you don't have to write down all this info. We'll have the recording available, and there is a handout that we'll be planning to share. So just wanted to mention that briefly here.
Perfect. Thank you for that. The next plan is the SEP IRA. And basically the SEP is really, in my mind, primarily for sole proprietorships. This is where we mostly see it being used. Oftentimes it's a business owner and a spouse, or a business owner and a child who run a business together. So you're really talking about the sole proprietor here. There is no capability for employees to contribute their own money to the plan, okay? So this is funded solely by the employer. Once again, the contributions are 100% vested. And when we think about this kind of a plan, I like to say that the owner is both the employee and the employer. Okay, so that's why oftentimes for the sole proprietor, this works, because it's my own money, because technically I own the business, right? So I'm putting the money in on behalf of myself as both technically the employer and the employee. Again, easy to set up, no annual filing requirements. So from a cost perspective, a bit easier to set up. Again, if you do have employees and you want to offer this, you need to offer it to all employees who are 21, at least age 21, and employed for 3 of the last 5 years and made at least $600 in compensation in those years. So again, to me, if you have employees that are remotely full-time employees and have been with you, you know, consistently for even a couple of years, they would all have to participate in the SEP. And therefore, depending on how much you put in, you'd really have to be putting in the same amount of money for them as you would for yourself. And it's not likely that that's what somebody is going to want to do. There is here a note about flexible annual funding requirements. And that's one of the other things we'll talk about when we look at some of these plans, is that when we get to a cash balance, for example, you're going to need to know that you're going to need to make a set contribution each and every year. You're making a commitment. When you have a SEP, for example, you have flexible funding requirements. So one year you might be able to make a contribution. The next year, depending on cash flow, you don't necessarily need to make a contribution. So there is flexibility here. You can get the maximum according to the IRS limit in a SEP plan for yourself if you're a sole proprietor, which is $58,000. Technically, it's up to 25% of compensation, limited to $58,000 in the year. So again, SEP, think of it primarily for sole proprietors, easy to do, and get you pretty much to that annual additions limit that we think of as $58,000.
Thank you, Donna. One thing I can add also, some people reach out to us generally around December. Things start get busy because people are like, I have not contributed to my retirement plan. When can I, you know, when is the deadline? So for 401k, that's already, the boat has sailed, right? So solo 401k for 2020, that's done. But for those who are attending or have not done something for their business, SEP IRA setup and contribution deadline is basically their tax filing deadline, right?
Yes.
So if you haven't done something for 2020 and you snoozed, you know, throughout last year, SEP kind of still can be your one-stop option for, you know, sole proprietor. You can still get it done, and you still have some time to set it up and fund it, and our team can assist. But 401k, generally, you have to set it up before the end of the year for that particular year as well.
Yeah. So there was, just to follow up on that, Aliredha, there was a little relief in the Secure Act that came out at the end of 2019, which basically got sort of, you know, kind of waylaid when everything happened with the pandemic. But basically, you can now put in a 401k plan for 2020 up to the tax filing deadline, but only for profit sharing contributions. Because to your point, the ability to put in a salary deferral out of a 2020 paycheck, that ship has absolutely sailed. So there may be more than just the SEP opportunity, again, depending on the needs of the organization, but that the Secure Act made it a little bit more flexible. So again, don't think that there's nothing that you can do if you didn't do anything for 2020 yet. We might still have some opportunity. So now the 401k, right? The gold standard, if you will, in retirement planning. Basically available for any employee, whether they're a for-profit or a not-for-profit. Both the employee and the employer can contribute to the plan. up to a combined limit of $58,000 plus an extra $6,500 voluntary if somebody is age 50 or older in 2021. Within that 58,000, there is a voluntary salary deferral limit of 19,500 or $26,000, which is 19,500 plus that 6,500, which gets me to 26,000. So a 40-year-old person can put in $19,500 of their own money, and a 55-year-old person can put in $26,000 of their own money into the 401k. And then the employer has the ability to fill in that bucket from 26,000 all the way up to $58,000. And how contributions are made by an employer in a 401k plan, that is where all the flexibility we were talking about comes in before. So an employer can make a matching contribution that says, hey, we're going to give you $1 for every dollar you put in, employee, up to 5% of your pay. Or we're going to give you 50% of what you put in up to 4% of your pay. These contributions by the employer can be discretionary, which mean they can change from year to year. So again, depending on the financial success of a business from year to year, the employer can do that. There are employer contributions you'll see down at the bottom here called safe harbor contributions, which are not nearly as flexible, where you as an employer are making a contribution, a commitment that says, I'm going to give you 3% every year, every eligible employee. And if I want to change that, I have to do a plan amendment. I have to send notices. It's not just that I can change my mind sort of whenever I want. These plans can have loans. They can have hardship withdrawal options, so that if I, as an employee, have an event where I need money to send one of my kids to college or something like that. So it basically has all the bells and whistles of a retirement plan. And again, with that, however, comes along things that we don't have in some of the other plans, like non-discrimination testing, the requirement to file what we call a 5500 form with the IRS every year, giving them information on the plan. Non-discrimination testing, excuse me, what this means is that the government says, no matter what, the fundamental thing, I think Aliredha would agree with me, that the government says is that you cannot discriminate in a retirement plan when you compare your non-highly compensated people to your highly compensated people. And according to the government, a highly compensated person is somebody who in this year makes $130,000. So if you make over $130,000 and are considered a highly compensated employee, we have to be careful when setting up plans that we're not skewing the plan to give those people more of a benefit. There can be some what we call permitted disparity. Not necessarily does everybody need to get the exact same contribution, but we have to be careful. And that's why there's testing done each and every year that firms like us at BPAS, we monitor the compliance, we run the non-discrimination tests, etc. So a 401k, like I say, this is really where, in my mind, employees of, larger plans for sure think that's what they should all have, is a 401k. In the small world, we understand now, after having looked at some other plans, that it's not necessarily that you need a 401k. There are other options out there for you. Anything you want to add, Aliredha, before I move to cash balance?
No, I think this is important to highlight, and for those who want to do, a lot of people are just familiar with that 19.5, but it's important to realize that if you combine that with employer plus employee contribution, then the limit goes higher, and there is that profit sharing component as well, right? That's where the limit goes up.
Correct. So again, if I'm an employer, right, again, I could be a relatively small employer, but that ability to put in $58,000 could be very, very attractive. So, and that is done, as you say, I said, kind of fill the bucket. That really is with what we call a profit sharing contribution. And it's a little bit of a misnomer. People sometimes get confused because they think, wow, I'm only going to get that profit sharing if the company has a great profit this year. That's not really true. I mean, it's called a profit sharing contribution, but it's really not based on profits, or doesn't need to be based on profits. Again, in the 401k, oftentimes the employer has a lot of flexibility. They could just, like I say, this year we're going to give everybody 1%. Next year we're going to give everybody 2%, or so it's not necessarily tied to profits, even though it's called a profit sharing contribution. Now, this next plan, the cash balance plan, really is a different animal than any of the other ones that we've talked about. The cash balance, all of the other plans that we talked about are what we call DC, or defined contribution plans. And what we mean by that is that those plans, what we're really defining is the contribution. How much is the employer contributing to the plan, right? So we're giving you 3% a year, we're giving you 2% a year. We're not promising you what that money is going to be worth at the end of the day, right? In any of those defined contribution plans we just talked about, the employee is the one who is investing the money, right? So ShariaPortfolio is building a menu of funds, perhaps many of them, that are compliant, with certain, plans, certain ideals, et cetera, that people, that a plan sponsor might want to have. And so that fund menu, then the employee chooses how they want to invest the money. In a cash balance plan, this is called a defined benefit plan. When most of you probably think about defined benefit plans, you probably think about what I call a traditional pension plan, right? Which was like, hey, I'm going to work at IBM for 40 years. And when I retire, IBM is going to say to me, hey, based on how long you were here and what you made, you're going to get $4,000 a month every month for as long as you live. That is what we all think of as a traditional pension plan. And most of us know that given the cost of those and the cost to administer them, many, many defined benefit plans have gone by the wayside. But a cash balance plan is kind of a hybrid. It has features of both the defined contribution and the defined benefit plan, and basically costs a lot less to administer and support. So anybody can have a cash balance plan. Only the employer, as was typical in a traditional defined benefit plan, contribute to the plan, but there can be a vesting schedule. Okay, and there is a promised benefit, like there was in a pension plan, in terms of the account balance. So each year, a participant account is credited with a pay credit, such as 5% of compensation, and they get a credit for an interest rate that is to be determined, okay? The employer bears all of the investment risk, unlike in the defined contribution or 401k plan, where if I pick a fund and that fund goes up and down, that's totally on me, right? I'm bearing that risk. In the cash balance plan, we're promising a contribution to the employee. So if we say you're going to get a 5% pay credit per year based on your compensation, and we're going to guarantee you a 2% rate of return on that, that is in essence a promise benefit, hence why the plan is really a defined benefit plan. The plan requires an actuary to do the work. These plans are definitely more complex. They can be a little bit more costly because you need an actuary. They are more involved. However, these plans can be layered on top of, for example, a 401k, where literally we can get a small business owner to put in up to sometimes $250,000 as a tax shelter. Okay, so we're talking about $58,000 in the defined contribution plan, and perhaps another $150,000, $200,000 into the cash balance plan. So for a small business owner who's making a lot of money, paying a lot of taxes, this is really a plan that you want to consider. So if you already have a 401k and you're looking for even more tax benefit, this might be something you want to talk to us about. I did say before, you want to have a stable business here. You need consistent cash flow because you really are making a commitment when you put in a cash balance plan.
Right, because there's no, once you commit to the cash balance, you have to stick to that plan generally for 8 to 10 years, right?
Yeah, I mean, maybe you could get away with 5 depending upon the owner, the age of the owner, but you're really making, to your point, Aliredha, a commitment to this plan. It's not going to be like, I'm going to put this money in. It's not going to be like, you know, sometimes we'll get a business owner who will say, hey, listen, I got a windfall this year because we sold off a business and I have this money for this year, but I only want to do it this year. Not really good for a cash balance. You're really thinking about it as making a commitment for at least a period of time.
Right.
Okay.
Now, one question that some folks might have is regarding this interest credit. A lot of our clients, in relation to their religious beliefs, do not believe in earning interest. So this is not really interest earning. This is just a credit that is being provided as part of that,
contribution.
Program.
Correct. Absolutely.
And I think when we look at the illustration that you have, I think that might help also kind of illustrate that point.
Absolutely. And that's where I'm going next, as long as this will move. Here we go. Okay. So just a few things about which plan is right for my company. So again, this is where, you know, ShariaPortfolio and BPAS come together and say, okay, here's the client. What are their goals? This is the first thing. Am I looking to just maximize my own contribution? Am I looking to recruit and retain key employees? Am I looking for a tax shelter for the business? What are really the goals of the plan? Sometimes one of those will largely overshadow all the others. And sometimes a business owner might say, I want all of that. And that's absolutely fine. But we just want to get to the heart of what the goal is so that we know we're setting up the right plan. Level of contribution permitted, right? So again, if I'm only looking to really create a plan for my employees to kind of put their own money in, I may not be concerned that they can't get in the full 19.5 or that I can't get in $58,000, but we want to understand that. Administrative responsibilities. Again, as we talked about, some plans are more administratively cumbersome than others. A simple plan might be something that somebody just needs when they're looking for simplicity. Cost of the plan, as Aliredha mentioned, you know, some plans are more costly to implement and then to administer. The cash balance plan, you get a huge benefit, but you're going to pay an actuarial fee that you're not going to pay in any of the other plans. We just talked about these last two really, longevity of the company and the owner, and a fixed commitment or flexibility. I mentioned briefly, if you have a lot of turnover, you might want some flexibility so that you're not vesting everybody from the get-go. Those are the types of things that we're going to look at to say what plan is right for my company. In the essence of time here, this, I know we're going to get these to everybody, but in the essence of time, this just sort of shows you by plan what the limits are that can be gotten under each plan. And again, as we said, we're talking about smaller limits in a simple plan all the way up to huge limits when you're doing what we call a combination of 401k with a cash balance layered on top of it. I want to make sure that we have a minute to look at this example. So we put together a client illustration for you for Dr. Siddiqui and his wife. And basically, the doctor is age 50. He owns the business. His wife is a spouse who's 48 years old. They both make a very healthy $285,000 compensation limit, which, by the way, is the maximum limit. This year, actually, it's 290. When we did the chart, I need to update a little bit. It went from 285 to 290. But basically, even if a business owner made $700,000, the government says the most that you can look at in a year for that person's compensation when doing calculations is 285,000 or now 290, which is why we use this number here. So basically, if they said we want to do everything that we can to the full extent of the maximum that we can save, here's what they could do. They could each do $19,500 as a salary deferral to a 401k plan. The physician can do an extra $6,500 to the K because he's 50 or older. We can give them a profit sharing contribution into the 401k plan of $17,100 each. And then based on their age and the actuarial calculation that we did, the doctor can put $162,000 into the cash balance plan, and his wife can get in 147,000. So in total, the doctor's putting in 205, 100, and the spouse is putting in $183,600. So they're close to $400,000 in 1 year in tax deferral when we layer these plans and combine them together. And what does that get you? That gets you, in this scenario, an estimated tax savings annually of $167,000. That is otherwise you're paying tax on, versus now you're saving those tax dollars currently. If I take that almost $400,000 and contribute that every year for 10 years, okay, and I assumed a rate of 5% rate of return, might be a little conservative, but I'd rather err on the side of being a little conservative. It gets them to a projected balance after 10 years of almost $5 million or $4.9 million. This is a true way to build real retirement dollars and secure, a very successful retirement plan for a small business owner, and in this example, a spouse. The cash balance plan really works when the owner is, or the owners are older, and if they do have employees where there's a lot of disparity. So the best scenario is an older owner with a lot of young employees, right? Because the younger the employee is, the less we have to give them because they have more time to earn money and build up money over the period. If the owner is older, we can sock away a lot of money because of the time horizon to retirement. So this gives you an idea of what an illustration would look like. I'm going to move on and see if we have any questions that come up about that. I just want to address here quickly parties to a retirement plan. So plan sponsor in the middle, investment advisor providing education and providing a menu of funds and monitoring that menu is basically what ShariaPortfolio would do. In our world, as I mentioned, because we can do many things under one roof, BPAS can be the third-party administrator doing all the compliance, the record keeping, and the trust and custodial work all under one roof. But sometimes these parties can be broken out. We have plans where we only act as the third-party administrator. If you're already working with a record keeper and you just need a new TPA, etc. So we just want to let you know who the parties are and that there's flexibility with respect to that. What to look for when you're looking at those providers: expertise, transparent and competitive fees, the ease and convenience of working with them, a dedicated plan sponsor support. Basically, all of our plans get a dedicated plan consultant that works with you. And I know that that's how ShariaPortfolio works. And the other final considerations, fiduciary considerations. When you put in a retirement plan as a plan sponsor or an employer, you are a fiduciary to the plan, meaning you have certain responsibilities to run that plan prudently. When you hire a firm like ShariaPortfolio, who basically selects and monitors your investment funds that make up the menu for people to choose from, you are limiting your fiduciary responsibility related to that by engaging ShariaPortfolio to do that. A couple of the last things we want to talk about is when we would start to work with you on a plan, we want to understand what is your tax structure like? How are you as a small business owner getting paid? W-2, K-1? Do you own any other businesses? This lots of times we ask small business owners all the time, and they're always like, why do you need to know that? But if you are a small business owner and you own 4 or 5 small businesses, and you come to, us or ShariaPortfolio and say, hey, I want to open a plan just for one of my 5 businesses, we might have to talk about that, because depending on the ownership, if you're in what the government considers a control group, you might need to offer the plan to everybody. So lots of information here, lots of nuances between the plans. Again, hopefully this is just a broad overview for you to understand that there's opportunities out there, and that experts at ShariaPortfolio and here at BPAS can help you wade through some of this. So thank you so much, and I'm going to turn it back over to you, Aliredha.
Thank you so much, Donna. That was an amazing presentation. I wonder how you managed to do it in that span of time, because
I was worried.
No. I think that those were all great points, and we cannot cover everything at once. Her contact is there, and so is mine, by the way, for those who are wondering how to get in touch with us. What I am going to do now is turn to some of the questions so that we can try and address these. One of the questions is, will these slides be available? Absolutely, they will be. In terms of the presentation recording will be there. There's also a small a PDF that we'll plan to share for those who are registered, so you can benefit from the information covering the differences between the different plans. But just to dive into some of these questions, and I wanted to mention there's a poll that we were planning to do. So please do answer this poll. Which of the following would you be interested in learning about? Because we're thinking about potentially doing a presentation down the line on self-directed 401k plans or 403b plans. So if that is of interest to you, please do answer this this poll, and we'll take that feedback on and think about what might make sense for future webinar. But regarding some of the questions, I heard folks using their LLCs to fund retirement accounts, example, Roth IRA for their children. Is this something you can explain how this can be done? I mean, you can, I think, set up Roth IRAs for your kids as long as there is earned income. This is a question that sometimes comes up. And as long as your children are making money through whatever, business that they're involved in through, if it's in your LLC, I think the main key point is that there is earned income. Is there anything else you want to mention on that one, Donna?
No, I think that makes sense. I mean, they do have to have earned income, and sometimes it's just enough to cover, the contribution that they want to be made. But and again, it's a little bit more. I would say when an accountant is looking at the business, these are things that they're more likely to look at a little bit more closely than maybe they used to. Because
is there an age thing also? Because sometimes I see people like, my son is 2 years old. Can I start? Right. I mean, I don't know if that's realistic,
Yeah, again, I think those are the types of things that accountants will shy away from nowadays, because the IRS kind of cracked down on some of that. But when a child, if you have a 17-year-old child, an 18-year-old child that might still be in school, but you can say is working a little bit for the company and has some earned income, I think that would not raise any real red flag.
Got it. Good point there. So that hopefully addresses that question. One other question that came in is, if I'm contributing to my employer-sponsored 401k plan because they're a W-2 employee at IBM, for example, can they set up a retirement account outside of that through their own personal LLC, make some contributions there as well? What is the opinion on that? I know you are allowed to set up multiple retirement plans, but what are the considerations there?
Yeah, so you can definitely have more than one retirement plan. As a matter of fact, you know, a lot of my background is in not-for-profit organizations in hospitals, and I often had many times nurses who worked sometimes at 3 different hospitals, right? Different shifts at different hospitals, and they contributed to 3 403B plans, or somebody who works 2 jobs and contributes to 2 401k plans. You absolutely can do that, but what we should be reminded of is the limit, the voluntary per person limit of what we called before 19,500 or 26,000 if a person is age 50 or older, is a one-time annual limit per person. So I could do $10,000 in one 401k and 9,500 in another 401k. I cannot do, however, 19.5 and 19.5. Okay,
Right.
so I get one individual voluntary limit. When we start to talk about employer limits, those are based over those individual limits. But as an individual with my own salary deferrals, I get one limit. I do see this question though. So it looks like though they're asking about if they can make after-tax contributions because their employer doesn't allow after-tax contributions. So I need to understand a little bit more specifically about why after-tax contributions, because you could probably also think about just setting up an individual non-tax deductible IRA and maybe accomplishing some of the same goals. So I need to understand.
I think sometimes they might also be thinking, which I do see this question, can I do a 19.5 pre-tax in the company sponsored retirement and then an after tax like a Roth 401k for the other 19.5? Well, no, you can.
Correct.
19.5 is regardless of Roth or pre-tax. And
correct. Right. So again, that 19.5, very good point, gets split between pre-tax and after-tax dollars. But somebody, depending again on how much they earn, because there is, you know, some caps on that. But I could do a pre-tax 401k contribution and an after-tax contribution to a Roth IRA. If I make too much money to contribute to a Roth IRA, then I think what this attendee is asking could be a perfect solution. I set up my own retirement plan through my LLC and I make a Roth provision available. And
correct.
Then I have,
or they can do a backdoor Roth, which is something that
yep,
some of the clients end up doing.
Exactly.
And we're happy to discuss that with any individual as well. So I think we addressed that already. Are these plans appropriate for nonprofit organizations? So setting up a retirement plan, 401k or simple IRA, is that something that would be applicable to a nonprofit?
Quite frankly, in the not-for-profit world, I usually see either a 403b or a 401k. You're not going to see a SEP here because there's not really the ownership, the same type of level of ownership that you're seeing in a small business with a sole proprietor. Perhaps a simple plan might be in a not-for-profit organization, but I would say by and large, you're really going to see a not-for-profit have either a 403b or 401k.
Okay.
And on that same note, I did see another question before about can we provide information on larger plans? And absolutely, both of our organizations work, as we said, with from very small one-person groups to, you know, to large groups. So again, and that's a not-for-profit is a spin-off, which we can certainly address separately.
One question is about the menu of funds on that particular 401k plan, for example. So generally in the 401k plans, a lot of them may be limited by a certain asset category like mutual funds, but a lot of the plans can be designed to allow for a lot more flexibility with the open architecture that BPAS provides. For example, you can set up a 401k for a company and allow a provision for a brokerage option or a self-directed option, in which case the menu expands a lot more and you can benefit from individual stocks, ETFs, as well as mutual funds. So just something to keep in mind. And that's something that, depending on the needs of the company, we can address that one-on-one.
Yeah.
Let me see what other.
I just would like to add one thing to that, Aliredha, which is that there should be a distinction made between a 403B in the not-for-profit world and a 401k. And this again is a government rule. So in a 401k, through that window, that self-directed brokerage window, you can absolutely buy ETFs, individual stocks, individual bonds, etc. Okay, a very, very broad universe. In the 403B, you can have that self-directed brokerage window and buy other mutual funds to have a more expansive, choice than just the core menu. But the 403B rules do not permit individual stocks or bonds, unless the not-for-profit is some sort of organized under some sort of church plan. And I don't mean church per se, but under some, for example, religious affiliation, you might be able to do it. But if I'm talking about, let's just say a hospital, for example, they would only be able to invest in other mutual funds, no individual stocks or bonds. So there is a little bit of a nuance there.
Fabulous. I think we have addressed most of the questions as far as I'm aware. One thing I will go backtrack to that 401k defined benefit combination, just to highlight one more point here, is that as you can see here, the max amount that someone can put in, as Donna mentioned here, is up to 400,000 potentially. And the idea here sometimes is, the main point is the tax savings. Look at the tax savings of 167,000 potentially you're saving. And that's where the big benefit comes in taking advantage of these types of plans. Because sometimes employers might get hung up on, I have 5 employees, but I don't, I want to keep the plan benefit towards myself. I don't want to offer anything extra beyond my salary that I'm giving them. Well, if you think about it, 90% or more of the benefit generally goes to the business owner, right? And then that, even though you might have to give a little bit of profit sharing to the rest of the team, for example, you're still taking the lion's share for your benefit, and you're saving yourself a lot more in taxes. So it's important to keep that in mind. Even though you saw the return rate that we were estimating of 5%, we can achieve a higher return potential depending on the type of strategy, for example. But the biggest benefit that I want to highlight is this, is the tax savings. Sometimes the question comes up as, well, I don't want to pay a setup fee or whatever administrative fee. You might pay a small amount for that again, but the tax savings will far outweigh that. So these are some of the questions that I've got, I do come across, but I thought by seeing this visually, it might give the people an idea as to what potentially is, beneficial for them from the big picture idea. So
right. I think that's a very, very good point. When you think about, that I might be able to, get in, and if it costs a couple of $1,000s to the firm to have a plan like that per year, number one, those are expenses that are expenses to the business. But if it can allow a small business owner to shelter that much money, it, to your point, might very, very well be worth the effort.
So one last thing I'll mention is, for anyone who wants to know, okay, well, I want to know what plan makes sense for me. Well, we'll share something with you that will kind of give an overview or summary of some of these plans with any of the attendees, so you can kind of still look over that. But we're here also available if we need to do an illustration or some kind of proposal for your company. Once we have a little bit of details, whether it's a nonprofit or a for-profit business, we can still take that information, look at the type of corporation we're dealing with, and then do an illustration that can try and take a look at what the contribution amounts might be, what are we looking to maximize the tax savings. So again, based on the need and the goal that you have in mind, these are things that we can work with you on the back end, and hopefully that will give you an idea as to what you can take advantage of for this year. And I think, BPAS has good experience in this space. Our Sharia portfolio has helped many clients take advantage of these types of plans, be it a simple plan, as she mentioned, it's simple, or if you're looking for something more robust with a lot more features and capabilities, we can go all the way up to the cash balance, with the solo 401ks as well. So thank you all for attending. We truly appreciate your insight, and we hope you can join us in future webinars. Again, as a reminder, for those who did not join the whole time, the recording will be made available, and it will be posted also on the Sharia Portfolio Media section. Anything else, Salahuddin or Shafaq, that we wish to mention?
No, we are good to go. It was an awesome presentation by Donna and yourself. So I think there's tremendous amount of information that was shared. So those who attended, of course, might have learned quite a lot.
Well, thank you for having me, and I hope everyone has a good evening.
Thank you. Take care.
Thank you. Bye-bye.
Thank you very much. Assalamu alaikum.
Bye-bye.